also happen is that we have a grant and some time along the line, we don't meet the conditions of the grant anymore. And then we have to repay the grant. So when there's a repayment of a grant, there are certain rules that we have to apply. And it is actually very easy, but all you need to remember is when there's a repayment of a grant, you have to do the T accounts and the calculations from the beginning when you receive the grant. Because the main objective with a repayment calculation of the grant is that we need to calculate what is the balance on the deferred grant income account that we have if it was income-based, asset-based grant, but we showed it as other income. And the same for the asset, we have to see what should have been the carrying amount of the asset, and then we have to make certain adjustments in the accounting records. So we've got an example of that. I just want to quickly look at the theory, and then I will show you the T accounts for the two options where it was income or if it was a deduction from the cost of the asset. So a grant becomes repayable, and we have to account that as a revision as an accounting estimate. All right, so the current year and any future periods will be affected by the accounting estimate change. So a grant related to income, we first apply to any deferred income credit, and if the payment exceeds this credit, then the rest is immediately shown as an expense. Okay, so let's go back one step. We've got two grants, either income-based or asset-based. If it is an income-based grant, what do? Every year, a portion of that grant will be transferred from the deferred grant income account to the income statement. So what happens when we have to repay? We have to first see what is the deferred income credit amount, and the repayment amount is first offset against that. And if the payment exceeds that credit, then the rest is shown as an expense. So I just want to show you quickly how that looks, that we can understand it properly. So for instance, we receive a grant of 100,000 to cover salaries. Year one, salaries is 100,000. Year two, the salaries is also 100,000. It covers 20% of our costs. All right, so what does that mean? In year one, we will say 100,000 salary cost times the 20%. So let's just highlight this that we know which one is which. Salary cost, and we say salary cost, and we have the 20% and the 20%. So our grant that we received was 100,000. And that is our opening balance on our deferred grant account. So in year one, we will recognize 20% of 100,000. So 20% will be gone. In year two, it will again be 100,000 expense times 20%. And we will recognize another 20,000. All right, so what is the balance after the first 2 years? It's 100 less 20 less 20, and that will give us a balance at the beginning of the third year. And now the question will say, at the beginning of the third year, one of the conditions of the grant is not met anymore, and we have to repay the grant. The grant rule says when we have to repay, we have to first apply the repayment to the deferred income credit. And what is our credit? 60,000. And if the payment exceeds that credit, then the rest will be shown as an expense. So if we look at what we have, we will say our repayment is 100,000 because we have to repay the grant. So we will say bank credit with 100,000. Deferred income will be debited, with 60,000. And that's the 60,000 that is our balance on the deferred. We've got the yellow already. Let me use that one. And we will say debit salaries for the 40,000. And that 40,000 is made up of the 20K in year 1 and the 20K in year 2 that we've already taken off our expenses in the previous 2 years. So we repay 100. We first have to see what is the balance on our deferred income account, and we have to clear that first. So we have to get that out of the books. So if you look at the T account, deferred income has got 100,000 credit. Year 1, we showed 20,000. Year 2 was 20,000. And then we have a balance of the 60. So the 60,000 now will go to bank and our account will be 0. All right, and the other 40,000 will go to salaries. So what we reduced our costs with in the previous 2 years will now be an increase in the cost of 40,000 on that repayment of the grant. And this is what happens when it is income-based. All right, are you all with me on this one? It's not difficult. You have to just go and calculate what is the balance that is left on your deferred grant account. All right. So then we have the asset-based one. If it is related to an asset, we must either increase the carrying amount of the asset or reduce the deferred income balance by the amount repayable. If the grant is related to an asset, the accumulated additional depreciation that would have been recognized to date should be an expense in the absence of that grant, and we should recognize that immediately as an asset, as an expense. So accumulated depreciation, deferred income must be restated immediately if that portion of the grant has never been received. So what we have with an asset is, remember, forget about what is on the screen now. If we have an asset-based grant, there are 2 options. The one is where we show the asset after the grant as deferred income. So we would depreciate the asset and we would show the same depreciation rate used with the grant income. And each year we would show deferred grant income transferred to other income in the income statement. If that is the case, then we must first see if we have to repay, what's the balance on the deferred grant income account? And we clear that. And then the the amount remaining will go again to the income statement. That's the easiest one, because we have to repay the grant. If the grant is asset-based and it is linked to the asset and we reduce the cost of the asset, what happens to depreciation? We say cost less the grant to get the depreciable amount. So that means our depreciation each year is less. So if we have to repay the grant, what must we do with the asset's value? We must increase the carrying amount of the asset. And that's the first line there, if it is related to an asset. Because we deducted the grant previously, we must now increase the asset's value with the grant repayment amount. And because we reduced depreciation, we must add the additional depreciation that would have been there if we did not have this grant previously. So when you have repaid it, the cost of the asset should be the amount before the grant was deducted, and the accumulated depreciation should be exactly what it would have been if there was no grant previously. That is where we deducted it from the cost of the asset. So it is just knowing which method you used. Trying to exit here and it doesn't want to exit. Come on. I'm pressing the wrong button. All right. So if we look at, just want to get a clean page that we can do the T accounts. If we look at question 3, this is where we have to repay a grant now. ABC Limited is the company. They want to build low-cost housing. They were awarded a grant to purchase machinery that needed to start operations. All right, so the grant was awarded in 2009 for an amount of 250,000, and they should be doing the low-cost housing for an unbroken period of 3 years. That is one of our conditions. So remember at the beginning we said there are always conditions when we have grants. So unbroken period of 3 years, if there's any period of time that we are not doing what we are supposed to do in terms of the conditions, then we have to repay it. All right, so should they stop building before the end of the 3 years, then the grant have to be repaid in full. All right, so the 250,000 grant, we now have to see what we are going to do with the grant. Because we buy a machine, this grant is asset-based. All right, the cost is 500,000 and the machinery is expected to have a useful life of 4 years. So we depreciate over 4 years. All right. Due to unforeseen circumstances, they stopped building houses on the 1st of January 2011, but they intend to continue later. All right. So that means within the first 3 years, they have stopped. All right. And now what is the consequence? We have to repay the 250,000 grant. Oh, that's 25, 250,000 grant. So there are two methods. We're either going to show the grant related to the asset as deferred income. When we have to repay, this is the easier one to do. Or we have to say in number B, we have an asset. The grant is asset-based. We reduce the cost of the asset with the grant. That means depreciation is less. And then after 2 years, we have to repay. So if we have to repay the grant and we previously deducted the grant from the cost of the asset, then we have to now increase the value of the asset again. But because we reduced the cost of the asset with the grant, that means our depreciation for the last 2 years was also less. So we have to again now increase the depreciation to what it would have been if there was no grant previously. All right, so that is what we have to do now. Okay, so number A is where we show the grant as income. Number B is where the grant is shown as a deduction from the cost of the asset. All right, so let's look at A first. There are the journal entries. So what I want to do, I'll show you the T accounts for the deferred grant income account separately, then it's easier. So the first journal is where we receive the grant. All right, debit the bank, credit deferred grant income. Then we have got the cost of the asset, debit the asset with 500, credit the bank with 500. Then we calculate now for the first year depreciation. Depreciation is on the cost divided by the useful life. Because it is shown as other income, we don't deduct the grant from the cost of the asset. So the cost stays 500 and we will calculate depreciation on that. Because the grant is shown as deferred income, we will show the grant of 250 over the same useful life as what we use for the depreciation. So each year we will recognize 62,500 as a transfer from deferred grant income to grant income or other income. All right, that was 2009. Then we have the next financial year, and it is the same information. Depreciation, 125, credit accumulated depreciation. Debit deferred grant income with 62, credit the grant income or other income with the 62,500. All right, remember, number A, we are saying we do not deduct the cost of the grants from the cost of the asset. We just depreciated cost divided by 4 years, and the grant will be recognized 250,000 over 4 years. So what do we have on our T accounts for this one? We will have deferred grant income, and that's on the balance sheet, and we will have grant income in the income statement. So in 2009, we received a grant, 250,000. Let me just make more space here, sorry. Right, in 2009, we recognized 62,500. In 2010, we recognized 62,500. Remember, we've only had 2 years, year 1 and year 2. So each year we recognized 62,500 from deferred grant income to the grant. All right, then we have a balance after the first 2 years, and it will be 125. And that's half because 2 years of the 4 years have passed. And the balance is 125. Grant income, 2009 was 62,500. 2010 was 62,500. And remember, income statement just goes to your restatement of changes in equity. So it is just gone. All right, now we have to repay the grant. So when we have to repay the grant, what's the rule? I have to say the bank needs to be credited with 250,000. That's the easy part. Because remember, we don't meet the conditions of the grant anymore. I have to repay the grant. So I credit the bank with 250. For each debit, there is a credit. All right, we've got a credit of 250. The statement says we first look what is the balance on the deferred grant income account, and we take the first portion there. So the balance is 125. So in 2011, we will say 125 debit, and now our deferred grant income account is 0. And then the balance will go to the income statement 125, either as grant expense or we just offset it against grant income, but it will show as a grant expense because that is the only thing that is there. So you've got a debit of 125, debit of 125, and a credit of 250. So our debits and our credits are equal. And that is exactly what is on the last journal there. So there is the repayment. Credit the bank with 250. 125 goes to the deferred grant income account. We had to calculate the balance. It was 250 less year 162 less year 60, what I said 162 less 62,500 less 62,500, and the balancing figure goes to the grant expense. All right, and then we have depreciation for the year, and the depreciation is no change because we didn't offset anything against depreciation previously because we didn't deduct it from the cost of the asset. All right, so the next section is B, where we actually said we deduct it from the cost of the asset. So the information is the same. That's the grant. That's the asset. There we transfer to the asset, because we said we're going to deduct it from the cost of the asset. Not a asset, it's an asset. All right, so what is left? That's the cost. That is the grant that we deduct from the cost of the asset because it's an asset-based grant and we reduce the cost of the asset. So that 250 is that one there. And we have the cost of the asset of 500. All right. And then on our grant account, deferred grant account is a credit of 250 and a debit of 250. So after we've done that transfer, deferred grant account is 0 after taken to the asset. All right, reduce the cost of the asset. So depreciation will be less. All right, what was the previous depreciation in the previous example? Depreciation was 125 each year. Now depreciation will be less because we reduce the cost of the asset with that grant. So previously we had 125. Now we have 62,500. That's year 1. That's year 2. And again, cost less the grant to give us the depreciable amount divided by the useful life of 4 years. So can you see for each of the 2 years, our depreciation was half of what it would have been if we did not deduct the grant from the cost of the asset. All right, now what happens? Now we have to repay the grant. And now we have to restate the cost, and we have to restate accumulated depreciation, because both of those were amended when we reduced the cost of the asset. So if we look at the T accounts for this one, All right, that is what we have in the books. We buy the asset. Cost of the asset is 500,000. So that is the purchase price of the asset. Then we say we have a grant now and we reduce the cost of the asset with the grant. And there is the 250 where we reduce the cost of the asset of the grant. So that 250 is the grant written off against cost. All right. So 250,000 depreciable amount divided by our 4 years gives us depreciation of 62,500, 62,500. So that is year 1 and year 2 depreciation, 62,500 and 62,500. Now, after 2 years, what do we have to do? Now we have to repay. So the journal entry will be, I have to increase the value of the asset. So I will say bank is easy because we're going to repay 250,000 and I increase the value of the asset with the repayment of 250,000. Because the grant is repaid, we originally deducted it from the cost of the asset. So we have to increase the value of the asset again. So what is the value of our asset now? It's 250 opening balance plus the 250 repayment. So it is back to the original amount of 500,000. But what is the problem now? Our accumulated depreciation should be restated. So we should show accumulated depreciation, what it would have been if we did not have this asset previously. All right. So when we repay, our depreciation was less 125 is what we would have had, less the 62,500 because we have a reduction in the depreciation. So each year, 62,500 is the amount that the depreciation was lower because we reduced the cost of the asset. So 2 years times the 62,500 gives us 125 that we have to increase accumulated depreciation with. And that just means we have to say credit accumulated depreciation and debit depreciation with the 125. And that is the restatement of depreciation. Okay, it's a change in estimate. So to test yourself, what is the total accumulated depreciation there? It's 125 plus 62 plus 62, and that gives us 250,000. The cost now is 500. So cost of 500 less accumulated depreciation of 250 gives us a carrying amount of 250. The asset is 2 years old and we depreciate the asset over 4 years. So what should be left of the value? Half of the cost should be the carrying amount, and that is exactly what we have, because 250 is the half of our original cost price. So we know we restated the amounts correctly when we had to make the repayment. Okay, so if you look at the journal entries here, that first one, let me rather use a different color because that was the restatement color. That is the repayment. Increase the value of the asset with 250 and credit the bank with 250. Then we have to restate the accumulated depreciation and show accumulated depreciation to what it should have been if there was no government grant deducted from the cost previously. So that 125 is the restatement. All right, and then the current year, can you see now the cost is again 500. It's not cost less the grant, and our depreciation in the current year increases to the normal 125 that it should be without having the grant there previously. All right, I know this was quite a mouthful, but please have a look at this example to see that you are in line with everything that you should know for this. All right, are there any questions?